Thank you, and good afternoon. I'm Adam Bergman with Sterling Capital in Virginia Beach, Virginia. Earlier today, Mr. Munger commented on the valuation of China versus the U.S. market. My question for you is, are market cap to GDP and cyclically adjusted PE still valid ways to consider market valuation, and how do those influence Berkshire's investment decisions? Thank you.
Charlie, I think, I guess Charlie's overall value in China. I would say that both of the standards you mentioned are not paramount at all in our valuation of securities. It's harder. People are always looking for a formula. And there is an ultimate formula, but the trouble is you don't know what to stick in for the variables in it. But that's the value of anything being the present value of all the cash it's ever going to distribute. But the PE ratios, every number has some degree of meaning, means more sometimes than others. Evaluation of a business is, it's not reducible to any formula where you can actually put in the variables perfectly. And both of the things that you mentioned get bandied around a lot. It's not that they're unimportant, but sometimes they can be very important. Sometimes they can be almost totally unimportant. It's not quite as simple as having one or two formulas and then saying the market is undervalued or overvalued, or a company is undervalued or overvalued. The most important thing is future interest rates, and people frequently plug in the current interest rate, saying that's the best they can do. After all, it does reflect a market's judgment, and the 30-year bond should tell you what people who are willing to put out money for 30 years and have no risk of dollar gain or dollar loss at the end of the 30-year period. What better figure can you come up with? I'm not sure I can come up with a better figure, but that doesn't mean I want to use the current figure either. So I would say that I think Charlie's answer will be that he does not come up with China versus the U.S. market based on what you've mentioned as yardsticks. But no, Charlie, you tell him.
All I meant was that I said before that the first rule of fishing is to fish where the fish are, is that a good fisherman can find more fish in China if fish is the stock market. That's all I meant.
Yeah. I'm going to go back
to a happier hunting ground.
This doesn't really directly relate. I want to go back to one question that was mentioned earlier. I really think if you want to be a good evaluator of businesses, an investor, you really ought to figure out a way, without too much personal damage, to run a lousy business for a while. I think you learn a whole lot more about business by actually struggling with a terrible business for a couple of years than you learn by getting into a very good one where the business itself is so good that you can't mess it up. I don't know whether Charlie has a view on that or not, but it was a big part of our learning experience, and I think a bigger part in the sense than being involved with good businesses was actually being involved in some bad businesses and just seeing
how awful it was,
how awful it is, and how little you can do about it, and how IQ does not solve the problem, and a whole bunch of things. It's a useful experience, but I wouldn't advise too much of it. What do you think so, Charlie? Here,
yeah. It was very useful to us. There's nothing like personal, painful experience if you want to learn. And we certainly had our share of it.
Becky?
I'd like to ask a question that can serve as a follow-up to the question that Carol had asked. And Charlie, in that response, said that he thinks the Berkshire's businesses on the whole will do better than the S&P 500. Clark Cameron from Birmingham, Alabama, who owns 281 shares of Berkshire B, writes in and asks, why have you advised your wife to invest in index funds after your death rather than Berkshire Hathaway? I believe Munger has counseled his offspring to, quote, not be so dumb as to sell.
Yeah. She won't be selling any Berkshire to buy the index funds. All of my Berkshire, every single share, will go to philanthropy. So I don't even regard myself as owning Berkshire. Basically, it's committed, and so far about 40% has already been distributed. So the question is, somebody who is not an investment professional will be, I hope, reasonably elderly by the time that the estate gets settled. And what is the best investment, meaning one that there would be less worry of any kind connected with, and less people coming around and saying, why don't you sell this and do something else and all those things. She's going to have more money than she needs. And the big thing then you want is money not to be a problem. And there will be no way that if she holds the S&P, or virtually no way, absent something happened with weapons of mass destruction, but virtually no way that she'll have all the money that she possibly can use. She'll have a little liquid money so that if stocks are down tremendously at some point, they close the stock exchange for a while, anything like that, she'll still feel that she's got plenty of money. And the object is not to maximize. It doesn't make any difference whether the amount she gets doubles or triples or anything of the sort. The important thing is that she never worries about money the rest of her life. And I had an Aunt Katie here in Omaha, who Charlie knew well, and worked for her husband, as did I. And she worked very hard all her life and had lived in a house she paid, I don't know, $8,000 for at 45th and Hickory all her life. And because she was in Berkshire, she lived to 97. She ended up with, a few $100 million. And she would write me a letter every 4 or 5 months, and she said, "Dear Warren, I hate to bother you, but am I going to run out of money?" And and I would write her back, and I'd say, "Dear Katie, it's a good question, because if you live 986 years, you're going to run out of money." And then about 4 or 5 months later, she'd write me the same letter again. And I have seen there's no way in the world, if you've got plenty of money, that it should become a minus in your life. And there will be people, if you've got a lot of money, that come around with various suggestions for you, sometimes well-meaning, sometimes not so well-meaning. So if you've got something that's certain to deliver, it was all in Berkshire, they'd say, well, if Warren was alive today, he would be telling you to do this. I just don't want anybody to go through that. And the S&P will be I think actually what I'm suggesting is what a very high percentage of people should do something like that. And I don't think they will have I think there's a chance they won't have as much peace of mind if they own one stock and they've got neighbors and friends and relatives that are trying to do some, like I say, sometimes well-intentioned, sometimes otherwise, to do something else. And so I think it's a policy that will get a good result and is likely to stick. Charlie?
Well, as Becky said, the Mungers are different. I want them to hold the Berkshire.
Well, I want to hold the Berkshire too.
No, I don't like the. I recognize the logic of the fact that S&P algorithm is very hard to beat. A diversified portfolio of big companies, it's all but impossible for most people. But I'm just more comfortable with the Berkshire.
Well, it's the family business.
Yeah.
But I've seen too many people as they get older, particularly being susceptible and just having to listen to the arguments of people coming along.
Well, if you're going to protect your heirs from the stupidity of others, you may have some good system, but I'm not much interested in that subject.
Okay.
Dr. Bruce Hertz from Glenview, Illinois. I wanted to thank you for allowing me to attend. I feel both honored and blessed. My question for Mr. Buffett is, you've always advised us to purchase equities that appreciate in value. Yet, a few years ago, you sold your used Cadillac at a tremendous profit. How can you justify selling a depreciating asset for a significant profit? Thank you.
Yeah, well, actually, I gave it to Girls Inc., and they sold it, and that was kind of an interesting. A very nice guy bought it for $100 and some thousand, and I did not. And Girls Inc. got the money, and he came later actually with his family, and he drove it away without any plates. He was driving back to New York, and he got picked up by the police in Illinois, and he said, well, he started giving this explanation about how he'd given this money to Girls Inc. and was driving the car back, and he had this nice-looking family with him, and the cops were quite skeptical. But fortunately, I had signed the dashboard for him as part of the deal. And so they looked at that, and then they just said, well, did he give you any stock tips? And they let him go. And I can't recall ever selling a used car at a profit, but I don't think I've sold any personal possession. Well, I've got a house for sale.
You don't have any personal possessions.
Yeah. No, anything you see with a figure attached like that.
You're a fatter version of Mahatma Gandhi. Mahatma Gandhi.
The guy was a very nice guy that bought it, and his check cleared, so we're fine.
You've addressed the risk of driverless cars to GEICO's business, but it strikes me that driverless trucks could narrow the cost advantage of railroads even if the number of crew members in a locomotive eventually declines from 2 to 0. Is autonomous technology more of an opportunity or more of a threat for the Burlington Northern?
Oh, I would say that driverless trucks are a lot more of a threat than an opportunity to the Burlington Northern, and I would say that if driverless cars became pervasive, it would only be because they were safer, and that would mean that the overall economic cost of auto-related losses had gone down, and that would drive down the premium income of GEICO. So I would say both of those, and autonomous vehicles, widespread, would hurt us if they spread to trucks, and they would hurt our auto insurance business. I think my personal view is that they will certainly come. I think they may be a long way off, but that will depend. It'll probably, frankly, depend on experience in the first early months of the introduction than test situations. And if they make the world safer, it's going to be a very good thing, but it won't be a good thing for auto insurers. And similarly, if they learn how to move trucks more safely, tends to be driver shortages in the truck business now. It obviously improves their position vis-a-vis the railroads. Charlie?
Well, I think that's perfectly clear.
Yeah. Finally, approval all these years.